Today we'll be going over the 6 reasons why people lose money in the stock market. Number 1 is not doing any research. 2, trying to get rich. 3, ignoring fees. Number 4, not diversifying. Number 5, letting emotions drive their investment strategy. And number 6, complicating your investments. So first up is not doing any research. This is a really big hurdle for most people. They don't want to read. They don't want to consume information. They want to pay someone else to do this. The problem is there's a lot of finance gurus, paid newsletters, a lot of online articles, a lot of free, paid, premium, whatever may be available. You have to be able to cut through the noise. You have to look for the signal. You have to talk about what is going to make the most sense for you, what works best for you, whether it's a Morningstar report, whether it's watching CNBC, whatever strategy works best for you. Most people don't spend the time of analyzing a company. If they read the prospectus or presentation, watch, eat the product, drink, do whatever, test the service, doesn't matter. They get a very strong understanding of what a company's doing. They can easily go through all the recommendations, find out who's providing the best service, who's an industry expert, who understands the market economics, so that when you put your hard-earned money to work, it isn't put in the right places. So not doing your research is the first step of why people lose money. Number 2 is they try to get rich quickly. They try to take an online course. They try to day trade, buy and sell. They try to do something short term. They don't focus on the long-term strategy. They don't have a thesis in mind. They don't have an investment journal, which is something I recommend to everybody to write down. Say, this is what I thought on day 1. This is my macro and my micro strategy. This is what I'm thinking will work. This is what's going to happen. And you come back in a week, analyze your results, go over it quarterly, go over it annually, and see what works best for you. You're going to lose money by trying to emulate other people. You don't want to do that. You want to think long term. You want to think several years out, if not multiple decades. It will help you to make better decisions over the long term, and the market does well over the long term. So get rid of the get-rich-quick schemes or must-have investments, and focus on what makes sense to you, is within your circle of competence, and makes sense over the long term. Ignoring fees is number 3. A lot of the investment companies and brokerage houses and ETFs have very high fee structures. You can look at 2 different types of investments. A lot of guys will try to charge, upsell, a lot of premium rates for investors that are just, 1, uneducated, 2, don't read the details, so they'll miss that a 1% fee may result in like 3%, 4%, which is 3-4 times what you thought. It will eat into your compounding rate, and you can't get that money back. The advisor or the money manager will be taking all those fees. So you want to look at the lowest cost fee structure. The low fees, don't ignore fees. They will eat into your returns. Number 4 is diversifying. You don't need to be 500 plus investments. You don't need even 100 investments. You just need to have more than 1. Statistically, they say to have 30, but you really want to have enough to say, hey, I'm invested in 1, I'm invested in 2, they're not correlated, and when something happens, they don't all take a hit. So if you're heavily invested in technology, for example, and there's a bubble, and it's inflated, and eventually the cash runs out, it won't help. But if you invested in technology and manufacturing and some vertical supply chain companies and something that was not correlated to what's happening to the entire basket of what your portfolio is invested in, it will help you weather volatility and make it through the long term. Number 5 is letting emotions drive investment decisions. You want to get beyond this. You can make investments without using that emotional piece of your mind. Emotion is probably driven most by emotion, so you want to focus away from just looking at news or reading things that don't have an impact on what you're looking to stay focused on. So if you're looking at Coca-Cola or buying a house, you don't want to look at something that talks about shipping or something that's just third world related that doesn't help you focus on your core efforts. So you focus on a specific company, you focus on a specific product, you stay focused in your lane and within your circle of competence. And then complicating your investment is number 6. If you don't have a very simple and easy way to look at what is in your portfolio, understand, take a quick snapshot to understand where you are. You don't want to be invested in so many things that you can't even grasp where your money is, how it's working for you. And that really gets back to, ignoring fees and ignoring product structure and not understanding where your money's being put. So if you don't do your research, so not complicating it, keep it simple, it helps. So those are the 6 rules. There are 6 reasons why people lose money. Evade them. If you evade them, at the minimum, you will not lose money if you're focused on the long term, because you invest and invest again, and you keep investing in good ideas, and you reduce your costs, and you double down on winners, and you cut out losers. So do your research, focus on low-cost fees, diversify to an extent, and then simplify your investment strategy. Those are my tenets. Those work. They work for a lot of investors. So give it a shot. Let me know how it is. Subscribe and comment below.